All right, all right, all right. Oh, welcome back, ladies and gentlemen, to another Stocks to Buy live, baby. And it's a perplexing moment in time where we're going to talk about the insider trades when it comes back to good old politicians buying into those war stocks before war took place. And those stocks are pumping pretty dramatically after hours while the rest of the market is crashing. So the question you got to ask yourselves, are you going to trade the war stocks, or are you going to buy the dip on these stocks that you absolutely love? And that's a question that I'm going to answer for you because I have not been buying a whole lot of stocks over the last little while. I went pretty crazy on the tariff war dip, kind of taking a breath back for the most part. So I do actually have some investable cash, and nothing feels better than when the markets start tanking and there's some investable cash. But I am always a little annoyed with myself because, hey, I heard the insiders were buying war stocks literally last week, and I thought to myself, I could just buy them and hold them for a week, or oil stocks and just see what happens. And I was like, nah, I'm a long-term investor. Why would I short-term trade? And here I am looking at these war stocks being like, I literally looked at these a week ago and I could have made some quick money. I feel like I need to have some like fast money that I just leave around for real short-term trades. Do you guys have accounts like that? But either way, once we get through the war trades themselves, I do want to talk about kind of the long-term view of where the S&P 500 is going. Because with AI and with the lower half of the S&P 500, I recently saw in the All In podcast some discussions I want to bring up. And then we also had Tesla launching their self-driving, which I want to show some clips from and offer some commentary to as well. So this should be an action-packed evening, folks. So if you are on a path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button. I'm going to try and explain from my understanding, and I could be wrong because God, man, knows this Iran and U.S. situation is complex. There's a lot going on here. But from my best understanding, there was sanctions that were already brought into place with Iran from a variety of countries around the world saying, hey, look, you want to have a fruitful future, you want to join capitalism and raise money, sell your oil globally. Well, look, we'll be easy going on you, but you can't make nuclear weapons, bud. And Iran's like, all right, I won't make nuclear weapons. But then as they started to scale over time, Saudi and many other Middle Eastern countries were like, hey, we don't like how much control you're getting here and all this other stuff. And, these rules around sanctions started to get a little bit more loose, and Iran said, fine, if you're not going to follow the rules, then we're going to start making nuclear bombs. And we're going to start building nuclear, uranium processing facilities and all this stuff. And it's only going to be for peacekeeping, obviously. And then obviously that raised further tensions, and one thing leads to another. And here we are. At least that is probably the most crudest and, probably most misunderstood way of explaining this conflict. But, either way it happened, and here we are, just watching it from the Western world, trying to figure out what's going on. But sure enough, if you are a politician, war is meaningless. War is just to make money. War is to control, have power. And that's what we're seeing going on, right? And a lot of people were kind of speculating, too, that they said they would, obviously, they're obviously, saying that they're going to attack back by blocking, what's that called, that Hormuz area that basically is the transit of like 20% of the world's oil. And they said that they would actually block this, and there's been a lot of speculation about what the retaliations look like, because they said they're only going to attack US stations in the Middle East and basically block oil. And oil has been spiking obviously on the conflict, which is good for oil trades. Oil is continuing to rally a bit here. But again, in this article, I think they point out a few good facts that anytime these conflicts have gone on with Iran, there has been oil spikes, but they've usually been short-lived throughout the history of moments like this. So they're saying, don't get overly excited. But again, if you are a trader, there is a lot of opportunity in this market right now. And this is like another one of the reasons that I do like having that exposure to some of the Canadian markets and, commodities that Canada offers, because oil seems to be doing pretty well, especially with the production increases from Canadian natural resources. Like even with oil down, their production levels have been exploding, leading to the stock doing still fairly well, considering it's pulled back, but it's been a good buying opportunity here, I imagine. Nonetheless, if we take a look at the markets themselves, again, pre-markets aren't looking too rosy right now. Everything is tanking, especially the tech companies right now. We're seeing Google, Meta, all my favorite companies kind of coming back down, and after hours or pre-market trading today. So that's what I'm kind of looking forward to. But what a lot of people are looking at are these Congress people that have been buying and loading the boat on these army stocks, these war stocks. As Unusual Whales has been pointing out, here are all the current U.S. politicians who are benefiting with the aerospace and defense stocks if the U.S. goes to war with Iran. And I don't even think they have to go to war. They just need to do this attack. And knowing that this attack was coming, comes back to the idea of, why are these people allowed to own these companies? Why can people that have insider information be allowed to own stocks that are directly involved in political policy. It's super fascinating and a conversation that should be had, because if you looked at any of these pre-market stocks, which you're not going to see on Google, I could pull it up on my trading accounts here and show you guys. Let's just take a quick look at, first and foremost, Lockheed Martin. Obviously, this is the more favorited and most understood war stock, because they directly make, bombs, they directly make planes, and a lot of the stuff they have with government contracts. This is currently trading up right now 2.41% in pre-market, and is probably the actual worst traded company pre-market. We have RTX Corp. This one's arguably doing the best. I mean, it's up. Not only is it up 26% year to date already, which is just, already ridiculous returns, but it's actually up about 4.34% pre-market right now. So it is pumping pretty hard. And my God, if you bought the dips this year on this guy, you've been crushing it. Again, this should have been maybe self-explanatory when, this whole Israel and, all this stuff in Gaza, all this stuff started taking place. You have Northrop Grumman here. This is another one of these stocks that's pumping pretty hard in pre-markets. This one I'm not as familiar with. I'm trying to find it here because I do have it. It is trading up 5.89% right now in pre-market. This one, what is this? This one is a what is this? It's an aerospace manufacturer active in the arms industry and space industry. This one not doing as well this year up till recently. And like I said, you could have bought this last week and you already would have made really decent returns. We have L3 Harris Technologies. Again, I'm not very familiar with these. Are all fairly new to me. This is also a defense contractor and information technology service provider that produces products for command and control systems and wireless equipment and stuff like that. So this one right now, year to date, is actually up 20% as well. Again, most of these gains have really only come into play within the last month, since the beginning of May. So you can't, it's really, peculiar here seeing all this activity. This one is trading up fairly significantly pre-market as well. It's up about 3% right now. It was up over 5%, but has pulled back a couple percentage points in pre-market as of this moment in my trading account. So I find it, just super wild. These should have been super self-explanatory trades. These are things where I feel like an idiot, where it's like the writing was on the wall with these, and there's probably still going to be good upside moving forward, but Trump leaks all this stuff. He was already saying that they might have got involved. They were thinking about getting involved. There were so many hints. I mean, you could trade Trump like there's no tomorrow at this point. The guy just leaks all the insider news. We saw all this stuff come out, even though they're pointing this now an hour later on unusual whales. Actually, the news came out well over a week ago that Congress was buying up a lot of these stocks, which led to further speculation that the U.S. was going to get involved in this war with Iran. And here we sit now, and we're all just sitting here like this should have been obvious. So congrats to anybody that actually traded into these war stocks. Again, do you guys think I should start just a little day trade account where it's just just for moments like this, where it's this should be obvious. It's very hyper fixated news. I mean, what's the downside potential in these major companies that are worth $50 billion? They're probably pretty limited, especially if you're just going to hold them for a week going into something like this. That was, again, should have been quite obvious, the writing on the wall. I don't know if I'd get into them now, but I'm still contemplating that, this probably isn't over. And, we're in the midst of a lot of stuff that could still continue to do well for these stocks over the year. If you just wanted to make a quick 5 or 10% bag, which again, in a short period of time, there's nothing wrong with that. I'm not a guy trying to push for the 20% gains off this, but if you got in early enough, you did some options plays, you probably did pretty well for yourself. But what do you guys think? Yo, Kyle, what's going on, brother? Not buying any war stocks, siding with a Canadian in a t-shirt on this one. What's his opinion on this one? Does he not get too involved? Again, morally, it's corrupt and it's horrible that politicians, I think, are allowed to do this. It seems like the most corrupt thing imaginable, that not only are people dying as the result of this, but the fact that people are allowed to have the insider knowledge of it and then actually go out and play options against it. Again, we know it's obvious that people are doing this. This isn't Trump has completely made it legal, basically, and these guys are obviously not going to go to jail. And worst case, if the paperwork slides across his desk, where they actually ban politicians from trading these stocks, it won't matter because they've already done it and they never get investigated anyways. The bag has been made. It's kind of ridiculous, really. So is what it is. But like I said, it's weird because in my earlier days of investing, I always found it morally icky to be involved in this stuff. But as I've aged, you start realizing at the scale of every major company, any company that's worth like $100+ billion, there's a good chance they're getting sued for people dying for some reason. In fact, I mean, you know, people have died at Tesla factories. Like once you get into this $1 billion, $100 billion, $1 trillion game, there's usually people dying at some level of your business over something that you've done. I mean, you look at drug companies. I mean, you name it. I mean, what Johnson & Johnson started the entire friggin' opioid crisis that we still have today. I mean, there's always problems with owning these companies, right? So, I mean, you start realizing the moral justification. It's hard to sit there and want to hold the flowers and be like, you know, back in the 1960s when you're protesting war and all this stuff, because I don't have control over any of it, but you do have control over your investments, and making money is making money regardless. So, you know, you got to find that moral ground where you're comfortable. But so far, I don't trade this stuff. I'm more of a long-term investor. So I've been debating it, though. I've been debating it. It hasn't hit me yet. Canadian ONG stocks are a better play in my mind for war. Yeah, you know, more than likely. Again, those come back to long-term holds though too, right? Like a lot of the stocks that I love that I would play for oil, I already have exposure to regardless. And let's be real, if you've owned VDY or any Canadian market stocks right now, you're still outpacing the US. So even with this, if oil prices spike, guess what? You're going to do better regardless, because most of the Canadian markets are oil-based anyways, right? We'll talk about Aduro, some of the small caps soon, Google the moon. We'll get to that in a minute as well. But yeah, do you guys got any other thing? Not buying any war stocks? Yeah. So I don't know. We'll see what happens. How is the Tesla self-driving in Austin? Okay, so maybe we'll pivot a little bit. We can talk about some of this stuff if you guys want. But before we talk about those stocks specifically, it does lead into this question right here that I think is really interesting to me personally. This All In podcast, they had a lot of good discussions around AI recently. But there's one point of this podcast that really, really just hit home with me, and it has a lot to do with a lot of these companies that I love, but I wanted to hear your guys' thoughts on this because they're not exactly wrong.
The average profit margin of the S&P 493 is, drumroll please, 12%. The average growth of the S&P 493 is, drumroll please, single digits. So to your point, why would you be long any of these 493 companies that may turn around and one day just get decapitated by something you don't even know, that's getting cooked up by a couple kids in a garage using OpenAI or Grok or what have you? It just makes a lot more sense when you find investable companies in the big themes of the future to, at a minimum, hedge, right? Be less long the past and, frankly, make some bets about the future. And I think that that's where you're seeing these IPOs just absolutely rip. What is a better comparison, in my opinion, are the companies that are truly levered to the future themes of AI and crypto versus any of these IPOs that have happened of companies that are not. And I think what you see is there's a dispersion there as well. And they are being treated almost as similarly, Jason, as the S&P 493. Mm-hmm. It's like, yeah, it's good. Yeah, it's fine. They get some reasonable gains. But if you're levered to any of those two trends, you're off to the races because it's just so disruptive. People don't want to be bag holding these old legacy companies.
This is such a fascinating, such a relevant topic for investors. And it comes back to the point of, I feel like we're going through a generational upgrade at an exponential level, unlike before, which is kind of crazy to think. If you were born in like 1900, you saw the first planes take off. And then within 30 years, those planes were dropping bombs on your neighborhoods, depending on where you lived, which is just absolutely insane. Like the level of innovation and seeing that disruption was wild. But now it's like, seeing that integrate in life, I think is probably just as crazy as like what we're about to witness with every single company across the board, right? And the question we have to ask ourselves, like, I think Chamath is really like beating up the lower half of the market. And let's pull it up real quick because I think it's an interesting look just into the bottom half of the S&P 500 stocks and how they're actually going to lever AI or robotics. And I can see it quite clearly with a lot of companies. I mean, you can't tell me like McDonald's has so much efficiency, they're going to be able to lock into their company, right? I mean, everything from ordering through drive-through, that's going to become robotic. Eventually, their entire kitchens are going to become robotic. Like you can see the margin expansion that could happen with fast food chains. But I mean, you really got to ask yourself, like, you got to ask yourself where those margin expansions are going to be, because it's where the most money is going to be made in the S&P 500, right? And I love that he's kind of crapping on like a 12% return after inflation. You're still probably, 10% or lower. single digits, kind of what he's referencing to. But regardless, I still like the S&P because it's going to market cap weight those best companies. But we do know that a few companies are going to have real monopolies over, a lot of these softwares. And it's going to come back to the point of monopolies, and if the government's going to step in to any major extent. But let me just find, did I pass it? Where are the top holdings here? Show me the holdings, because I just want to take a look at the lower half of the S&P here, because we all know the top players are going to be where the money's at. Am I just blind? Did I just keep skipping over it? There's dividend. VOO, where are our holdings? There we go. Did we pass them? Why is it not showing me? Am I just blind? Did they update this? I want to see the portfolio composition. I want to see the holdings. The VOO update their site or something, or am I just missing something here? It should be right below this. No holding details, funds. Why does it just say dividends from capital? What is going on here? Fund management. VOO, what is, my Lord, what do they change here? Take me to the fact sheet then. It's not just used to show the top holdings. Why is it just showing me the dividend information? Am I slow here? Slow, not stupid. Let's hope. Let's just go S&P 500 list. Save myself the embarrassment of not seeing that. Show me the S&P 500 by weights. Yeah, so let's just take a look here real quick. Because Microsoft, this is really complexing, right? Because we know the top holdings right now, Apple, Microsoft. You can argue these any day of the week, what one's going to be a leader in AI and how they're going to integrate it, sure, whatever. But the real question is investing broadly in the S&P 500. Like, you got ExxonMobil in here, don't really care as much. MasterCard, there's questions around this in crypto and how they're going to adjust to blockchain. Costco is a very expensive company today. I'm not sure how Costco can integrate AI or robotics to any major extent. Warehousing, maybe adjustments, moving of things. Sure, I get it. I don't see massive margin expansion there by any means. Procter & Gamble, same thing. I can kind of see Chamath's point on many of these companies. Johnson & Johnson, maybe on the healthcare side, the pharmaceutical front, obviously adjustments in, the whole pharmaceutical biopharma space. Sure. Home Depot, again, we're moving toward modular homes. I don't know how much Home Depot plays into the modular home side of things. Like I said, when you go through this, there's a lot of questions on how a lot of these companies are going to integrate. Coca-Cola, Philip Morris, a lot of these are just traditional older companies that don't see the same kind of sustained growth that the upper weighted AI companies do. So it's kind of perplexing. Like, Philip Morris is up so much when we talk about some of these tobacco giants, right? Because they've been a great trade as of recently. Like, Philip Morris is up 51% year to date, which is kind of insane, really, because when you look at the revenue on macro trends here, this is the first time that these guys have actually seen a real bump, but their revenue is not anything astonishing. They're growing at single digit paces. Their earnings per share isn't even higher than where it was in the past. There's just been a huge bid that has got captured in these tobacco stocks. And I'm not sure what's driving it or why they caught such a bid over the last little while, especially within the last year and a half. Because if we look at even Altria Group, and Altria Group, I think, is the most manipulative company when it comes to their books. Because if you just take a look, their revenue has done nothing but decline at accelerated rates. And the only way that they're keeping their stock up is basically by buying a crap ton of shares back, increasing prices, and slowly inching up their earnings per share. This is a dying company. The Western world is not a place you want to be for tobacco sales, right? Philip Morris is at least growing. British American Tobacco is doing fine, but nothing to deserve the growth rates that we're currently seeing, right? So it's really interesting to see that. But this is a lot of what we're seeing in the S&P, right? How do these companies adopt and see these massive margin expansions, but also take over these markets that all these companies need for sales? Because a lot of these companies are going to be buying AI sales software. They're going to be integrating the AI avatars and stuff into their national teaching systems and things they have to use for press releases and internal company documents. They're going to utilize, every one of these companies to some extent is going to be utilizing another company's AI software. And we know that's going to be some integration of the upper weighted companies. Because again, self-driving, Tesla, Google, these massive social media networks that touch, half the world's population. There's so much room for growth and integration. And, even with VO3, all these companies have to do marketing. They're going to be using AT&T. How does AT&T upgrade and get massive growth rates? So I can completely understand what Chamath means, though, when you look at the vast majority of these companies and they're very old companies that do not is Boeing even growing? Boeing is the 66th largest company, and are they even growing and comparable right now? I mean, their stock's up 15% year to date. Hasn't done nothing in the last like decade. The stock's barely done anything. Let's just take a look at their revenue. What's been going on with these guys? So like, this is the same problem and kind of what, yeah, they haven't done shit in a while, but this really kind of brings me back to like why I sold SCHD, right? Like if I was in retirement, again, I love the idea of the tobacco sector. Like if I needed cash flow, and even in retirement, like I'm not going to give up 100% on growth, but like, I mean, this is the exact reason I got rid of SCHD, because like when the market was going up for the last decade, it was a great ETF to own. It was in line with the S&P 500, but they did own quite a variety of different stocks that were, in my opinion, much better than the current constitution and their top weighted holdings, because this stock hasn't done anything. And I held this for since 2021 and the stock's barely done anything. It's up like 4%. Yeah, you've collected a 3.5% yield, but you can't tell me you wouldn't have been better off, owning the S&P 500 since 2021, and in roughly the same period, you would have like 50% gained plus the 1% over that 4 years, right? So, I mean, you would have been doing substantially better. There's been quite a divergence between the S&P 500 and some of these dividend ETFs that do hold the more traditional lower half of the S&P 500. And as somebody that is always forward looking, I don't believe past performance equates to future returns. It's nice knowing what the past looks like, understanding the mechanisms that got the market to where it is, but you do want to understand the underlying holdings that sit in these ETFs, where the weightings are, and where we're going moving forward. Because I always want to be exposed to the best stocks moving forward. And that leads into what we've been talking about here. Like, I find myself naturally doing this, and same with my wife. And it seems to just come naturally if you're in the markets, is that we find ourselves starting to upper weight these individual companies, right? Like 20% of our portfolio is those bets on these companies where it just seems so damn obvious where the growth is going to be, right? And where you're going to see those extended rates of return. And I mean, we were just talking today how YouTube Shorts is now averaging 200 billion daily views. Is like, say that again, 200 billion daily views, a 186% increase from 70 billion just in 2024. And this so much reminds me of like Threads, daily active users, or even monthly active users, doesn't really matter. Let's just take a look here. How many? I mean, Threads, think about Threads wasn't even a thing like that long ago, and they have 100 million daily active users. And let's just take a look at the monthly and compare it, because I talked about this. Threads daily do monthly because we can compare it to X, right? Like it has almost just over half as much. So they have 350 million active users compared to X, right? So X has right now about 586 million monthly. So think about how big X was and how old X was and how Threads came out of nowhere to compete. And Threads is really closing the needle here. Like to be half as big as X already is insane. It's insane, right? But kind of going back to the Google topic, right? Like Google, it's crazy that just came out about the explosive growth that they're having in their shorts. And yet the stock is still trading at a 19 times multiple, right? And I saw this video, which is kind of interesting too, on the self-driving aspect of things, because it's just funny. I just see everyone congratulating Tesla, and they're so excited about Tesla self-driving and all this stuff. But Tesla's going through the same regulatory framework that Google had to do. There has to be somebody sitting in the seat monitoring the car in the beginning. It has to be geofenced. Everyone's just like, oh, Tesla's going to flick a switch and they're just going to completely destroy Google's market share. They can't. Like, you don't think Google yesterday would have had, like, because everyone's like, oh, Tesla has all the cars out there. It doesn't matter. Google can adopt their system on any car they want. They could have tens of thousands of self-driving Waymos out there now, but the regulatory environment just doesn't allow you to do it. And there were some funny moments, like, and again, even Waymo has some funny moments, but it doesn't matter if the car's safe or, if they mess up a little bit here and there. You can't really criticize them for that, considering we all know self-driving is already quite superior to a human driver. So people were kind of making fun of this little issue here where the car was trying to make a left. Out here a little bit, kind of came back in. And then there was a few other moments in here where the guy was almost going to stop it. I think, what time was that? I think people were pointing it out in the comments section. It was at 15:10. I think at 15:10 here, there was a moment where the guy was almost going to take over because some guy was trying to come in to the lane, which I think was right here. Just take a look. Yeah, this guy tries to do some weird actions. So this guy almost stepped in, but the car did do the right thing. It slowed down. like I said, people think that I just hate on Tesla for the sake of hating on Tesla. I think Tesla has the real capability to be, it's likely going to be like one of the largest companies in the future. I have nothing saying that's not going to be possible, but you can't help but recognize that they've priced in so much of this. It's going to take a decade to justify values. And this is why Tesla's trading at like super high multiples, and the stock hasn't had any growth for the last 5 years, right? I mean, it's just been sitting here kind of bobbing up and down, but revenue's flatlined. You know, their car sales aren't increasing. They're losing dominance in the EV market as BYD takes share. Again, I'm just saying that is like healthy criticism for a company that does trade at 177 times multiple and has lost all their earnings and only make money off interest income right now. That's the only thing keeping them above cash flow positivity. So I just don't understand, again, to me, why I'd want to buy a company like this at an insane multiple where I have to wait a decade to justify some of that growth, whereas Google has all that upside and is trading at an 18 right now, which is crazy. It's just, it's crazy to me. What is Google down right now in pre-market? Let me just take a look. Google is trading at, Meta's down about, not too much actually, 0.65% right now. What is Google down? Why isn't it on my watch list here? I should pull it up somewhere. But yeah, these stocks are all kind of tank. I hope they tank, and I hope they keep going down because I do plan on picking some more Google up this week if it's going to trade back down below the 170s for sure. But again, this comes back to the point. Like, I always feel like I'm taking on a bit more risk, but my gut just keeps telling me like I need to be buying and making sure like I'm upper weighted some of these tech companies. And like the people keep asking me like why I'm not buying the Qs. Like, wouldn't you just be better off cost averaging into the Qs? But then I come back to the same problem of like I want to cost average into the many because I know I'm not smart enough. I missed Nvidia. I missed, like, even if Tesla stays up and stays strong, like I know I'm not smart enough to understand some of this stuff, but I can still capture that upside. And I don't feel like I missed Nvidia because Nvidia was responsible for the vast majority of the S&P 500, the S&P 500 gains over 2023 and 2024. So like I was able to capture the best stocks gains and at least actualize some of that without buying it because I was too dumb to. But I do recognize that like some of these things I feel like I understand well enough, and I just don't want to own the vast majority of them because I don't. Again, I just feel like so many, like I think the Qs go beyond just tech companies, right? Where can I see the holdings in here? Let's see the fund details real quick. Because my thing here is if we take a look at the holdings, like what would I want to own out of this? Like, yeah, I like Microsoft. Nvidia, I like it. I don't understand it well enough. Apple, lacking innovation right now. We own some Apple individually. It's not a huge position, but Apple's kind of becoming a cash cow where they're not really innovating. Seems like they're relying on everybody else right now, which I'm not a fan of because they forefronted Siri and Siri is shit. And now I have Gemini on my phone that is taking like letting me use video to interact in a very like fluid voice. Whereas like I still argue with Siri, she sucks so bad. But yeah, I mean, Amazon's great. Broadcom, I don't really understand. Meta's great. Netflix, sure, fine. I don't like Netflix that much, but it's crushing it. I wouldn't own it individually. Tesla, I wouldn't own individually. Costco's way too expensive to own individually. Google in here, sure. Cisco Systems, I don't understand. T-Mobile's in here. Palantir, I think, is way too expensive. I don't want to own it here. Intuitive Surgical, I don't understand. Texas Instruments, I don't understand. I wouldn't own Pepsi here. It's just like every half company, I wouldn't own it in here. Adobe, I definitely wouldn't own in here. Like they have to really catch up. Honeywell, sure, is fine. Micron, I don't understand. Palo Alto, don't understand. Shopify, I wouldn't own here. Shopify is a great company and people love it, but you have to understand, like, I can't imagine that Google can't snap their fingers and have a website generated AI model. I mean, Wix, all these companies are now using AI to generate websites. It's a very competitive software right now. So I'm just like perplexed by a lot of these, and it could be to my own ignorance that I don't own the Qs. And I still think the Qs could be a great place. I don't like PayPal at all. PayPal's in here. PayPal I hate with a passion. They're the worst company out there for transaction. Even Coca-Cola, European partner, Europe Pacific's in here, which is interesting. Yeah, there's a lot of interesting stocks in here. I mean, I have nothing against the Qs. Honestly, I should just own them. I mean, like, let's be real. If I just wasn't so ignorant to Palantir, I'd have done fine if it was in here already. But I just think a lot of these companies are expensive. I don't understand them, but I do feel like I understand Google, Meta. There's stocks that I just want to upperweight. So we'll see if it's to my own detriment, if it's a mistake or not. But I think to some extent, like, you need to have funds like this that upperweight these stocks for you. I'm like I said, I'm not shitting on the Qs. It's just my own personal preference that I'd rather hand select some of them because I look at Meta and Google trading at way better valuations against Tesla and Palantir and some of these other stocks. And they have way more capital than some of these companies. They have way more upside potential. They have limited downside in comparison to something like Tesla, in my opinion, at least in the next 5 years. So like, I don't know. We'll see if I'm making the right decision or not. But like, as to Shamoth's point, I just don't know how you don't want to own some of these and you just, like I said, time will tell if we're right, but it just seems like the easiest trade in the world, at least the next 3 to 5 years. I don't know how you do wrong. I'll keep trimming Palantir, but up over 500% on it. Yeah, I mean, like I said, I missed that trade, and congrats to anybody that got into it. And again, now is the time to start taking profits if you haven't already, because again, I get that it's a great company, and I still believe Tesla is one of the greatest companies in the world. Again, people think I'm so critical on Tesla. I love Tesla. I'd love to get back into Tesla. But you have to recognize that valuations eventually do matter. And we've seen it happen over the last decade, time and time again, where these companies pull forward 10 years of value and they do this quick run up because of the hype. And then if you're the guy up here buying it at a 600 times multiple and it only keeps growing earnings at a 20 to 30% clip on average, like it's going to take a long time for you to justify a 600 times multiple, right? At a company that is already worth $300 billion, like crazy to be trading at a 600. And again, this is really comparable to NVIDIA, right? Because NVIDIA peaked, I think, at what was NVIDIA's peak multiple at its fastest growth rate? And NVIDIA is doubling its earnings. Palantir is not even close to doubling its earnings, I think. I'd have to double check. But if we look at like NVIDIA's PE history, and we'll do a quick comparable on macro here. Let's see what their peak was, because I think NVIDIA peaked at around what? I think it was over this, but yeah, it was trading at 150 times multiple. And again, this was trading at a similar valuation to what Palantir is trading at right now. But I mean, if you just take a look at that growth rate, like look at the earnings. They went from 76 cents to $1.19 to $1.71 to $2.13 just within 1 year. The stock went from 76 cents to $2.13. They almost 4x'd their earnings. You could easily justify a 200 or 300 times multiple when you are tripling, quadrupling your earnings in a year. You know how crazy that is? Let's just take a look at Palantir comparably, Palantir PE history on macro, just to show you the difference in these companies' growth rates. Because this is why I just think it's kind of overvalued, because they're again trading at a 600 times multiple. Their earnings have basically stayed the same. So far, we haven't seen that explosive earnings growth rate. And if we take a look at the revenue growth rate, comparably growing at 30, and again, 40% is great. I mean, these are huge numbers. What was NVIDIA's revenue growth rate at the same time? Revenue on macro. Let's take a quick look at the same thing from the revenue side. Yeah, I mean, look at this. Like NVIDIA was growing the revenue at 200%. So I'm like, I could justify NVIDIA, but like, how do you, like, you're really like, you know, Palantir's really got to show some major growth to start doing what NVIDIA did and justify the next $600 billion trillion valuation to bring down a 600 PE to at least 100 or 50 or somewhere closer to Tesla, right? So like I said, this is the time to take profit. I wouldn't be chasing these companies right now. I'd be very careful with a lot of the high flyers out there for reasons just like this. But again, it's a good time to take profit, shift into some companies that are trading at better values, that, you know, still have some major upside from here. But again, congrats, man. You crushed it, Jason. Jesus, you're probably doing way better than I am. I shouldn't have been so ignorant and just maybe took a bit of gamble money and threw it into Palantir. But again, like I have a hard time because I get a bit squirrely when I really don't understand the fundamentals of what's going on. And when people just can't explain to me the totality of their business, and they're just like, oh, they have all these government contracts, but I can't tell you what they do for the government. And it's like, oh, I can tell you what they do for businesses. All these businesses are using it, but I'm like, okay, but their growth rate isn't insane. Like, why would I pay such a high multiple when I can look at other companies that have better growth rates for the value that I'm paying, right? But again, I missed the trade. And, you know, if you caught that, again, like you got to understand momentum really carried that. So it feels like more of a momentum play at this point than a value trade. And you can tell that I'm more of a value guy. At least I have been to most extent for my investing right now. No, you're crushing it too, buddy. You keep things sensible. Yeah, but the problem is like, and I've said this in 2022 or 2021, that when the market gets crazy, you need to kind of get a little crazy with it. Like I thought about buying Hood on the dip. When I watched that major dip, I was looking at a lot of these more speculative stocks, and I was like, I knew I should have bought them because I knew that we were in a growth market and any dip is a buy. And like I looked at Hood, same with these war trades, and like, you know, I'm doing fine. I don't need to do this stuff, obviously, but when you know like what the capability is and you know the odds are much better and you're playing the casino, like I said, I would never walk in a casino and play because the odds are in the casino's favor. But when I have the information and the trends there, like, would it really be a big deal to have thrown, like, let's be real, like, let's go take a look, because I can show you right when I was looking at Hood stock. I mean, I was looking at Hood stock like back here and literally like right here around this area. I was just like, I knew that it was a good trade. And I'm like, I should have just bought it around here because I could have quickly saw 50 to 100% upside and I would have already sold it. Like after it probably ran up 30 or 40%, I would have been out of it. And it would have been a real easy trade just because of the market environment we're in, right? Like forgetting the war stuff because it hasn't like materialized. Like you knew the war wouldn't affect the market that bad because we're not in like any real severity where like there's been US attacks on US soil. We know that's not coming. Like people don't care. People are over the US politics side of things. And even this drop in the market that we'll experience with this Iran stuff, unless it escalates, it's only a buying opportunity because the market just won't care. And that's been the same for every past conflict. We've been through this a dozen times in the last 10 or 20 years. And you know, it's always been the same thing. Just buy the dip. You've been fine. But again, like you guys, if you know what you know, and you know the odds are in your favor and you're paying attention, like, again, I don't think it's a big deal to take 10 or 20 grand and speculate a little bit. But again, you know, I have my job as many of you do. So I kind of get a little bit in my head of like, I have a job. I can't worry about this shit, whatever. So yeah, it is what it is, right? But we're all doing well. I mean, these markets have been very generous to everybody. So I hope, you know, you're making money here. It's hard to lose money in this kind of market environment if you've just been long-term, right? Google will flip Apple in the next 5 years. Google should be the largest company in the S&P 500. I don't know why it's not. I think what's going to happen is they might have to divest Chrome or something, and I still don't think that's going to be as. Again, I think the monopolistic fines are what's holding Google back. Until that gets cleared up, and I've said this before, I don't think because they're all remedies. Like everything we've been hearing about divesting Chrome and Android and all this stuff, like that isn't concrete. That is just people spitballing ideas in court. I have a hard time believing that's going to happen, especially Google, because they've already lost. We know they lost. And they have another big court case coming up in the EU right now over Android's dominance. And they might have to pay like 20 billion or something stupid, but who cares? Like, I don't even think it's that much. How much is the EU fine? EU fine, Google Android. What's that at right now? I think there's speculation. Okay, so 4.1 billion pounds. Who gives a shit? Ooh, 4.1 billion pounds. Google's sitting on what, a fucking 150 billion in cash. It's not even a 1% drop in their bucket. So who cares? So I think it's just getting over the monopoly fine here in the United States. And again, I don't think the remedy is going to be as impacting as people are making it out to be, or at least as severe to the market value that's already been priced in. I feel like all of that is priced in right now. And again, my big speculation is there's going to be two major volatile moments for Google next. Firstly, we're going to get to an earnings period. We're going to get to understand the value of VO3, Gemini, the recent upgrades, and the $250 a month. And something tells me that is going to be groundbreaking, and people are going to be like, holy shit, they're going to be more like Microsoft in the future. They're going to be more, you know, software as a service, subscription-based models. Let's value them at a higher PE. But then in August, within, you know, by the time, what's Google's earnings date, the next earnings period, it's going to be all slapped together. It's going to be very volatile. Google earnings date. So we're going to have that fine coming up in August, literally just after they report earnings in July. So we're going to get earnings 1 month. Hopefully they crush it, but then we're going to get the monopolistic filings, the fines, what's going to actually happen if they have to divest some part of their business in August. Once we get through these two critical factors, then we can understand and have more certainty around the value of the stock. So I'm taking the absurd risk right now by buying it preemptively because a lot of institutional investors don't want to wait, or they want to wait to find out the certainty. They want that certainty. They want to know their investment is safe. And like I've told you guys, the way the market works is when there's more uncertainty, like the Trump tariff war, institutional investors, not retail, and I'm sure a lot of retail, because retail is just dumb for the most part, but institutional guys and, you know, a lot of AI algorithms and you know, bot trading, they're all like, look, we're going to sideline this until there's certainty. We don't want to risk what we can get a guaranteed return out of a 4 or 5% yield from a treasury or a money market fund. So they're going to set that money there until they know what happens. And then obviously as things level off, they're like, oh shit, we have certainty, buy back into the dip, watch the market rip as certainty bakes in, and we go back into the opposite pendulum swing. And that's what we're seeing with Google, right? So I'm presuming, again, that it's over dramatic and we're not pricing in any of the future upside right now. So if I can preemptively buy it, my speculation is there's about a 50 to 100% upside somewhere probably within the next year. I think if Google can run back up to a valuation that we see with Meta, which would be more fair, in my opinion, for what's going on here. And I still think Meta's cheap. I think Meta should be trading at least a 30 times multiple for the growth we're currently getting out of it, because they're growing their earnings at like a 40% clip, which is like crazy right now. But I mean, they're trading at a 26 times multiple for their growth rate. I think Meta should be at least a 30, 35. And I think Google should be at least a 25 to 30. And that would, again, that would take Google, it would take it up 50% from here at least. And then from there, I think obviously we'll go way higher because the market always over exaggerates, right? What's Meta doing right now? This is what I don't understand. Like, look at the bottom line of Meta right now. I'm really happy I picked up some shares on the dip, and I'm super happy we've held this stock long term, especially in the wife's TFSA. Like what a great company overall, though, man. It's been a marvel and a half. But the revenue growth, like, look at this. You got a company here growing at a 15-20% revenue growth. The earnings per share growth has been 30 to 50% as of recently. How is this company trading at a 25 times multiple? Like, you can't tell me Meta looks way more attractive right now than Palantir does. And like, I mean, they're going to monetize WhatsApp finally. Like, the upside this company has, like, I could foresee at least 10 to 20% revenue growth reasonably for the next 3 to 5 years. There's no reason that they can't do that, which means a 25 times, 30 times multiple is fair value. Like, there's no way that's not fair value for a company like this, if not slightly undervalued. So, I mean, they haven't really even started dealing with all the upside from Threads. I mean, like, same with Google. Like, Google has so much. Google's got Gmail. They have all this integration they could use for their AI. Like, you got Gmail, you got Android, like, they got everything. So we'll see what the court case brings too. But yeah, these are my big bets for these obvious reasons, right? So I'll probably buy more of them. And what I'm going to probably do is adjust my entire TFSA, because I'm over leveraged in Take Two right now, my TFSA, but I only have Google and Take Two in there. But I think I'm thinking too short term, and I'm just throwing money wherever I had money to buy. But I think I'm going to do a serious reallocation, and I'll update you guys on it to like actually properly adjust the weightings in my tax advantaged accounts, because I should have some Meta in my TFSA and I don't. I only got Google and Take Two. Take Two, I've got like 20,000 US dollars worth just in that one account, and I've only got like 10,000 worth of Google. So what I'm going to do is try and like distribute these between my TFSA RSP and my corporate account. And I've been doing it so lackadaisically, just throwing money in these stocks wherever I have it. But I think I'm really going to adjust it properly and stop thinking so short term, because I didn't plan on holding these for the long run. And I'm just like, maybe the next 1 to 2 years, I'll take a lot of profit. But I'm starting to realize that like these are kind of stocks that I should just shut the market off for 5 years and forget about it, make them an adjustable weighting, like Shamath is saying. Like, you got to leverage yourself to some extent to the upside here, because these companies are already very safe to own. They've got a lot of cash, and some of them are trading at great value. So, I mean, is it that big of a deal to take 10 or 20% of your portfolio and just say, forget it? Like, I'm just going to park it here and we'll see where we go and just keep buying the dips. That's kind of my bet right now. As a 33-year-old, like I said, I'm less concerned about VDY. I like my S&P. I still like my VDY. I'm not selling those. I'm not that crazy, but I still recognize that I really need to take advantage of these dips and go and just see what happens. Google is even leading in the quantum race right now. I know, like, you couldn't even, this is the problem, right? Like, I only buy Google because I understand what I use it for. I use Google Ads. I understand Google Ads very well. I use YouTube. I use Gemini. I'm using all these apps. I see them getting integrated in my job. I mean, the future is understandable. You go talk to any kid. Every kid wants to be a YouTuber when they grow up right now. YouTube is the greatest like video platform that has ever existed ever. It has the highest viewership anywhere of any platform for video. Like, I mean, like, it's just obvious, right? I mean, it's so obvious. Did you sell Aduro? So I did take some profit on Aduro, my corporate account. I still have some shares, and I'm just kind of watching the volatility right now. But I did make some pretty decent money on Aduro. But I've been working for Aduro for 3 years, I think over 3 years now. So I'm glad the Aduro stories were really worked out, because I mean, that's just a company that a lot of my friends work for, and I understand them, and it's going to be neat to see, because right now the stock's going up on kind of, I think, people realizing the value. There's value there, but I really want to see the actualization still of, they got to convert some clients, they got to get their pilot plant up and running. So I mean, there could still be a lot of upside just on that stuff, but I'd be more comfortable if the stock was rallying on them being like finally just actualizing some client conversion and stuff like that. So that's where I want to see the company go still in the next 1 to 3 years. So I'm hoping it doesn't get like crazy and run up to like $1 billion and a half value yet. Like I love when companies trade at what I think are reasonable values, and then when they start executing, the stock goes up on the execution. I don't particularly like seeing stocks just endlessly pump when they still need to actualize what I believe to be the greatest value add, because then what ends up happening is the same thing that happens to a lot of companies like Palantir, like what happened to the Canopy Growth Corps of the world, the MJ boom, the crypto and NFT boom. Like what ends up happening is people just get way too excited way too early, and then you're forced to get out of it. And then I feel bad, because like I want to be a long-term investor. I want to be a part of these stories, but like you have to understand, like you cannot be a part of something that you have fundamental understanding of value of. Like if you're buying stocks, like you have to have a value where you're like, this is too expensive. Like look at Warren Buffett. He's been selling like huge chunks of Apple. Like everyone's like, oh, he's a long-term buy and hold forever. It's like not if the value metrics change and don't make sense. Like you're going to take profit at some extent. If you believe a company you hold that you've been up 1,000% on, and you're like, maybe this 1,000%, 400 time multiple company is a little expensive today, right? For where I believe the growth is today. So, you gotta just take that into consideration with companies you own. I'm not saying Aduro's there yet. Aduro, I think, deserves to be trading at a 300 to 500 mil market cap. And there's a lot of catalysts coming up in the next 6 to 12 months that I really hope they continue to execute on. And I'd like to see them get up to like $1 billion and a half value, but I'd like to see it all kind of come together in a nice cohesive way that makes sense. Because I mean, right now it's good, but if it keeps pumping beyond here, like you gotta start taking some profit at some point. Punishment for being too good is just wrong. I think they will pay a few $1 billion in crumbs to them anyways. Yeah, Google. Iran has been the wild card. So with these targeted strikes, Abraham peace accord can move forward. It will actually make the Middle East more stable. So long-term, no effect on the stock. Yeah, I mean, that could be the potential on that side of it. But yeah, folks, I mean, it's pretty wild out there. I can't believe we've been chitter-chattering for 45 minutes. It is crazy hot out here in Toronto, so I am going to go for a late night swim and then take it easy and get ready for the workday tomorrow. So stay cool, stay awesome. And as always, I look forward to catching you in the next one. Peace.